Welcome back to Talk Tickers. If you're new here, this is the show for the buy-side mind. We take those earnings calls that usually put you to sleep, strip away all the corporate fluff, and get straight to the numbers that actually move markets.
And today we are looking at Napco Security Technologies, ticker NSSEC. We're breaking down their fiscal second quarter of 2026.
And honestly, if you just looked at what this company makes, you'd probably scroll right past it.
Oh, absolutely. We're talking about door locks, commercial fire alarms, access control hardware. I mean, it sounds like the most boring business on earth.
Boring is usually where the money is, though. And the market reaction to this quarter was definitely not boring. We saw the stock rip 11.2%.
11.2. And it closed at $41.02.
And the volume was double the average. So this wasn't just some liquidity blip. I mean, people were piling in.
They were. And the question is why? Why is the smart money suddenly chasing a company that, makes door handles?
That's what we're going to figure out. The whole sentiment seems to be that NAPCO is pulling off a kind of magic trick. They're convincing Wall Street that they aren't a hardware company anymore.
But a high-margin software compounder disguised as a factory.
Exactly. But before we get to that whole valuation story, we have to look at the raw numbers. Because you don't get an 11% pop without a serious beat.
You really don't.
No. Right. So let's look at the snapshot. Fiscal Q2 2026. The headline number is the EPS.
Right. GAAP diluted earnings per share came in at 38 cents. The street was looking for 32.
So a 6-cent beat? That's nearly a 20% surprise?
And year over year, that's a 35.7% jump. That is massive growth for a company that's, been around for decades.
But usually when I see an EPS beat that big, I worry they just slashed R&D or marketing to juice the bottom line. Was this a quality beat?
It was high quality. This was not financial engineering. Revenue hit a Q2 record of $48.2 million. That's up over 12%. So they grew the top line. But the real story, the thing that likely caused that stock spike, was the margin expansion.
Okay, walk me through that, because hardware margins are usually pretty tight.
They are. But NAPCO's gross margin climbed to 58.6%. And for context, last year it was 57%.
Mm-hmm.
Adjusted EBITDA was up 26% to $15.3 million. We are looking at a 31.9% EBITDA margin.
Okay, almost 32% EBITDA margin is fantastic. And I saw the board raise the dividend
by 7% to 15 cents a share.
Which is the board's way of saying, we think this cash flow is permanent.
It's a triple stack quarter. You've got the revenue beat, the earnings beat, and the margin expansion, all of it.
All right, so the headline numbers are great, but I want to understand the machine. You mentioned they're trying to be seen as a software company. How do you justify that when they sell physical radios and locks?
It comes down to one acronym, RSR.
Recurring service revenue.
That's it. This is the heartbeat of the entire bull case. For this quarter, it hit $23.8 million.
Mm-hmm. Okay, up 12.5% year over year.
Right. But think about that. Almost half of their total sales are now coming from services, not the hardware itself.
Okay.
But here is the number that should make you sit up straight. The gross margin on that service revenue was 90.2%.
90%? That's absurd. That's higher than most pure-play SaaS companies in Silicon Valley.
It is, and that's why the market is re-rating them. When you have revenue with 90% margins, every single dollar of growth drops almost entirely to the bottom line.
Wow.
Management even flagged a prospective annual run rate of about $99 million based on the January numbers.
So they basically have a $100 million annuity stream just sitting inside this company. But practically speaking, what is the service? I get they sell a radio, but why is someone paying them every month forever?
It's the Starlink commercial fire radio. So think about a commercial building, an office, a school, a strip mall. By law, their fire alarm panel has to be monitored. And traditionally, that panel was connected to the fire station via 2 copper telephone lines.
Those old landlines that literally nobody uses anymore.
Exactly. And the telecom companies, they hate maintaining them. They're expensive, they break, and the telcos are actively trying to kill them off.
This is the copper sunset I keep hearing about?
That's the one.
Yeah.
The copper lines are going dark. But the fire marshal doesn't care about telecom economics. He just says the building needs to be monitored.
So the building owner is stuck, the phone line is dead, but they legally need a connection.
Enter NAPCO. They sell a Starlink radio that hooks up to the old fire panel, and it communicates over cellular networks. The owner buys the hardware once.
And then they have to pay a monthly subscription for the cellular connection to keep the fire marshal happy.
And since fire codes aren't optional, that revenue is incredibly sticky. You're not going to cancel your fire alarm subscription because the economy is getting a little shaky.
You can't. If you do, they shut down your building. That makes it totally recession-proof.
Precise.
Okay, so that's the software and service side. That's the exciting part. But we still have to talk about the other half of the business, the hardware, the actual locks and equipment. Usually in these kinds of hybrid companies, the hardware is a low-margin drag that barely breaks even.
And that used to be the case here too, or at least it was struggling a bit. But this quarter showed a really significant turnaround. Equipment revenue was up 12%, but the equipment gross margins hit 28%.
28%? I
Yeah.
seem to recall that being much lower not too long ago.
It was. It was 24% a year ago. It was 26% just last quarter. So it's definitely stepping up.
What's driving that? Is it just that they raised prices?
Well, that's part of it. The price hikes from late fiscal 2025 are fully sticking now. But the more interesting dynamic is what management called supply chain sanity.
Sanity. That implies things were pretty crazy before.
They were. If you look back a year or two, the distributors, the people buying NAPCO's gear to sell to installers, they were totally erratic. They were terrified of supply shortages or tariff hikes. So they would just sit on their hands for 2 months, and then in the last week of the quarter, they'd panic buy everything.
Which is a complete nightmare for a factory.
It's a disaster. You have to pay overtime, you have to pay for expedited shipping, you have to run machines at weird hours. It just kills your efficiency.
And now?
What management said on this call is that the chaos is gone. Buying was steady all throughout the quarter.
So because the orders came in smoothly, they could plan their production shifts better.
Exactly. No overtime, no rush shipping. That efficiency goes straight to the gross margin line. It's not just that they sold more, it's that it cost them less to make it and ship it because the behavior of their customers normalized.
Speaking of making and shipping, we have to talk about geography. There's a lot of noise in the market right now about tariffs, especially with China. Where does NAPCO stand on that map?
This is their moat. This really is. While their competitors are scrambling to move supply chains out of China, NAPCO is just sitting pretty in the Dominican Republic. The DR. They have a massive facility there. Labor costs are low, but the real advantage is the proximity. They can get a container from the DR to their distribution center in New York in 6 days.
6 days compared to what, 6 weeks from Shenzhen?
At least.
Yeah.
And with the tariff volatility, not knowing if a 60% tax is coming next week, having your factory in a free trade zone in the Caribbean is a massive strategic advantage. It just insulates them from all the trade wars.
So we've got the service revenue printing money at 90% margins. We've got hardware margins recovering because the supply chain calmed down. Let's look at the balance sheet. For a small cap company, are they leveraged up?
Zero leverage.
Ow.
They have zero debt. And they are sitting on $115.4 million in cash and marketable securities.
That is a fortress balance sheet.
It is. And they generated $14.5 million in free cash flow just in this quarter. It's a 30% free cash flow margin. So that pile of cash is just getting bigger every day.
Okay, so the inevitable question is, what are they going to do with all that money? Did they give any hints?
They signaled M&A, but they were very, very careful with their language. They use the word disciplined. They aren't going to buy a company just to buy revenue. They want things that fit their channel products they can sell to the exact same alarm dealers they already know.
That makes sense. But I noticed something else in the operational update that felt like a signal. They hired a new C-level executive, a chief revenue officer.
Joseph Popinski. He started January 29th.
So why does a new sales boss matter enough to even mention?
Because NAPCO has been around a long time, and it has historically been very founder-led. The sales process was, let's call it organic.
Right.
Bringing in an external heavyweight as a CRO, that signals a shift. It means they're institutionalizing the sales motion.
Meaning they want to build a sales machine that works, even if the founder isn't in the room making the calls.
Right. It suggests they're going to get much more aggressive and much more structured about going to market. They aren't just taking orders anymore. They are going hunting.
So let's talk about what they're hunting for. We've covered the quarter, but markets look forward. What are the catalysts for, say, 2027? What keeps this growth engine going?
Well, there are three main buckets. First is school security. Sadly, this is just a massive tailwind.
Yeah.
The funding is there, projects are active, but it's lumpy. Districts don't announce when they are upgrading locks for security reasons, so it's hard to track. But the demand is constant.
It's a grim reality, but from an investment standpoint, it's a steady stream of government spending.
Correct. But the second catalyst is the one I think is most fascinating. It's a new product launch they're calling MVP.
MVP, what is it?
It stands for their Cloud-Hosted Access Control. But the tech isn't the story. The customer is the story. This product is designed to pivot the entire business model of the local locksmith.
Wait, locksmiths. I think of a guy in a van who shows up when I lose my house keys.
That's the current model. The locksmith is a break-fix business. He fixes your lock, charges you $200, and then he leaves. He has zero recurring revenue.
Right. He only eats if something breaks.
NATCO is trying to change that. With the MVP product, that locksmith can install a cloud-based access system, say, for a small office or a gym, and APPCO handles the cloud backend.
And the locksmith?
The locksmith installs it, and then the locksmith gets to charge the customer a monthly subscription for managing their access.
So they are basically gentrifying the locksmith. They're turning a blue-collar trade into a SaaS reseller channel.
That is exactly it. They are giving the locksmith the holy grail recurring revenue. If this works, NAPCO unlocks a distribution channel that nobody else in Silicon Valley even knows exists. I mean, there are thousands of locksmiths out there who are desperate for better business models.
That's a really interesting narrative. You take this dormant army of installers and you give them a software product to sell. When does that actually hit the P&L?
Management said revenue contribution should become meaningful in the second half of this calendar year. So, fiscal 2027. It's the next leg of the stool after the fire radios.
And the third bucket you mentioned?
The partnership with ADI. ADI is this massive global distributor. The relationship is just starting to ramp up, but it gets NAPCO into huge national and international accounts that they just could not reach on their own. It's all about scale.
Okay, let's zoom out and look at the stock. We're at $41. We've got the growth, we've got the margins. But how do we value this thing? Is it expensive?
Well, that depends on what you think the company is. If you value it like a hardware manufacturer, yeah, it looks expensive. Hardware usually trades at 10 or 15 times earnings.
But you're arguing it's not hardware anymore.
The market is arguing it's not hardware. I mean, if half your revenue is recurring with 90% margins and you have zero debt and you're growing double digits, you start to look a lot like a Rule of 40 SaaS company.
Hold on. Rule of 40. Break that down for the listeners who don't spend their lives looking at software KPIs. What does that actually mean?
Sure. It's a quick rule of thumb for software investors. You just add your revenue growth percentage to your profit margin percentage. If the number is over 40, you're considered an elite company and you deserve a premium valuation.
And NAPCO clears that bar.
Easily. You've got 12% revenue growth plus a 32% EBITDA margin. It's a 44. So yeah, they are passing the test, and that is why the multiple is expanding.
And if you compare them to the index...
It's not even close. The one-year return on NAPCO is somewhere between 63 and 71%. The small cap index, the IWM, is up maybe 14% in that time.
So it's just crushing the benchmark.
It's a safe haven. In a choppy macro environment, investors want certainty. The copper sunset regulation provides certainty. The fire codes provide certainty. And that balance sheet provides safety.
Which brings us to the so what. We've analyzed the past, we've looked at the future catalysts, now it's time to get a little creative.
Is it time for the disclaimer?
It is. This segment is called This Is Not Financial Advice. We're not financial advisors, we don't know your portfolio, and this is definitely not a recommendation. This is just an outrageous but plausible trade idea based on the data we've been discussing.
All right, let's hear it.
I call this trade the locksmith leverage long. It is a long-short pair trade. You go long in a PCO, NSSC, and you short commercial office REITs.
Okay, I think I see where you're going with this, but walk me through the logic.
Well, the thesis on the short side is pretty obvious. Commercial real estate, specifically office space, is in secular decline. Vacancy rates are high, valuations are dropping, refinancing is a nightmare.
Right. Nobody wants to own an empty office tower.
But here's the nuance. Even an empty building legally requires fire monitoring. If the power is on, the fire panel must work.
True. The fire marshal doesn't care if you have tenants or not.
Exactly. And as these buildings get sold or repurposed or even just try to cut costs, the owners are looking at those expensive legacy copper phone lines and they're cutting them. They are retrofitting.
So NAPCO wins on the retrofit.
And APCO gets paid regardless of occupancy. In fact, churn in the real estate market buildings changing hands often triggers the code inspections that force the upgrade to the Starlink radio.
I see. So the turmoil in real estate actually drives the regulatory upgrade cycle for NFPCO.
Precisely. So you go long NFPCO to capture that regulatory mandate and the margin expansion. You short the office REITs that have to pay for these upgrades while they're bleeding tenants. It's basically a hedge against the physical economy imploding. Even a burning building needs a fire alarm communicator.
And the MVP product fits into this too, I assume.
That's the kicker. Wall Street completely ignores the locksmith. They think it's a dying trade from the 1900s. But if NFPCO successfully turns them into SaaS resellers, you are betting on the revenge of the locksmith while you're shorting the landlords.
I have to admit, I like the symmetry of it. It's contrarian, it captures the regulatory moat, and it uses the macro weakness as a catalyst. It's a very clever way to play this hardware transition.
That's the locksmith leverage long. Again, not financial advice, just something to think about while you're staring at those office vacancies.
It really just highlights the strength of the quarter, though. NFPCO delivered a perfect beat and raise without even officially raising the guidance. They just let the run rate speak for itself.
That $99 million run rate is the floor, not the ceiling. The transition to services is real, the cash is real, and the market is finally paying up for it.
And with zero debt, they control their own destiny.
That's a wrap on our deep dive into NFPCO's Q2 2026 earnings. As always, do your own diligence. These numbers are from the February 2nd report.
See you in the next print.